So this is limitations of the CAPM capital asset pricing model, which we discussed previously. And it is again, like I said, chapter number 15, F9. Cost of debt, we discussed this thing. We just calculated post-tax cost of debt. We just calculated WACC. So you will use your cost of debt while doing this WACC thing. Then you have bonds, debentures, loans, and notes. Now here I need to discuss with you quite a lot of things on bonds and debentures. And the cost of the bond can be estimated by considering the risk-free rate derived from the yield curve for a bond of that specified duration. So these are the words which are coming new for you. Probably the yield curve, and then specified duration, and so on. So let's do like this. I'll give you some understanding of the bond so that it become easy for us to continue with this thing. So we talk about bonds. Actually, we need to know this thing, information about bonds, not only in this chapter, but we will be using this information in our next 2-3 chapters when we will doing, in advanced investment appraisal. We will be using bonds in concept there as well. Now, what is a bond? We know that bond is a debt instrument. Okay, because it is a debt instrument because it has a fixed rate of return, and it usually has a life. It usually has a fixed maturity. So what we have here, let's suppose that this is your bond. So how it is written, it says that $100, and it says that 5 years, and it says that 6%. Okay, so these are generally very simple standard thing. $100 bond with a 5-year maturity and a 6% coupon rate. So let me first introduce you with the terminology. The face value, which is also called nominal value of this bond, is $100, and its maturity is 5 years, and the coupon rate is 6%. That's pretty much simple. Now this bond, it always has it has coupon rate. Let me write down here. Coupon rate it has, and it has, which is 6%. And the market value of this bond and the face value is $100. Now what happens? That there is something which is called market interest rate. Market interest rate means that on average what market is paying. Let's suppose that market is also paying 6% interest. So investor can buy this bond and earn 6%. And by the way, what does that mean? It means that if you purchase this bond today, or if anybody will buy this bond today, they will spend $100, and then they will start getting $5 and $5, and then 5, and then 5, and then 5, and here 100 back. So this is what it means. That, I'm sorry, it is $6. So we will pay $6, $6, $6 for 5 years, and in the last year, you will get back your investment as well. So the bond is giving 6% earnings, and the market is also giving 6%. Both of them are same, and therefore the market value of the bond is also 100. So $100 face value, $100 market value, because both are offering the same interest rate. Now forget about some other factors. We know that this is the value which is written on the bond, and you call it face value, okay? But the market value of the bond, it may go up, it may go down. In the market, the price can go up or it can go down. The market price is not fixed. This price is fixed. Market may change. And why the market changes? The market changes with the market interest rate. Let's suppose that in market, the interest rates, they become 4%. The banks are offering 4%. If the banks are offering 4% and this bond is offering 6%, so what will happen? Everybody will start taking out money from the bank and start buying the bond because the bond is giving better return. And therefore, the demand of this bond will increase and its market price will go up probably to $105. You come to me and you say, are you selling the bond? I say, yes. For how much? I would say $105. You will say, but on the face it says 100. Why are you charging more? I say, because this bond is giving you better returns than the market. And you also see that it is giving $2 more every year. So you would say, okay, I will pay you 105. Alternatively, what can happen? That if the market interest goes to 7%, if market interest goes up, bond has the same coupon rate, which is 6%. Now, who needs this bond? Nobody needs this bond, okay? Because this bond is giving a lower income, lower earnings. Investors are always looking for increasing their returns. So people will start selling this bond and start putting money in the banks. Nobody needs this bond now. So the price of this bond will go down. Probably it will be, I don't know, maybe it is $95. So this is how the price of the bond is changing. So what we just learned, we said that you have got market interest rates, okay, and you have got bond prices, market price of the bond. They move in the opposite direction. If market interest rates, they go up, bond price, it goes down. And if the market interest rate, they go down, bond prices, they go up. So first of all, you need to remember or establish this behavior in your mind. By the way, bond prices, this market price of the bond, it is not only dependent just one factor. There are many other factors as well, but so far at the moment we are discussing just the relationship between two. This market price of the bond, actually it depends on many factors. I just discussed one factor, which is the market interest rate. There are some other relationships as well, which probably are the risk of this company, what is the credit rating, AAA. For example, let's suppose that this company is, let's suppose that this is the current situation. Forget about this thing. So let's suppose this is the current situation. Market is still giving 4, the bond is still giving 6, the price was 5, but then suddenly the price goes down to 101. Why it happened? This did not change. This happened because of some other fact. That other fact was that it had a rating of AA. Now its credit rating has been decreased to A. So when the credit rating of any company goes down, they are facing some financial difficulties or there are some other problems. Naturally speaking, the bonds, they will become more risky and their value will go down. So we will discuss this concept later on, but right now what I'm focusing at the interest rate. But like I said that there are other factors as well. And I just gave you example of one factor, which is the credit rating. So we learned one relationship. So I had some, how to say, learning objectives with you, what you need to know, what you need to understand. The first concept is that this market price, what is the relationship of market price and market interest rate? So you understood this thing. Now, second thing, there are some terminologies which we use here. And when I say, there is a word which is called maturity, and there is a word which is called duration. These are two different words. Probably it looks like in language, it looks like the same. Maturity 5 years, duration 5 years. Probably it looks like the same, but they are not same. Maturity is the life of the instrument, okay? 5 years, for example, 5 years. Duration is the time period required in which the investors will collect their investment. For example, if you invest $100, let's suppose that in a bond, the bond has a life of 5 years and you invest $100. And then there are 5-year period. So are you going to collect your $100 in 5 years? If you collect $100 in 5 years, then this bond is not giving anything actually. I mean, you give 100, you get 100. No, actually what happens that you believe that this bond, I am investing 100 and I will probably get back 130. So actually this 100 you are going to recover until this point. Okay. And this remaining period is your profit period. So your initial investment of 100 will not be recovered in full 5 years. Actually, probably you will be recovering your investment in 4.6 years. And the remaining time period is your profit time period. This is the time period where you make profit. Otherwise, if I make 100 today, if I invest 100 today, and then I get back 100 in 5 years, so it means I'm not making any profit. So mostly, generally, the duration of the bond is less than its maturity. So duration is that time period. Duration is that time period within which you recover your investment. So this one terminology you should be clear in your mind. So this is the difference. And by the way, we have this Macaulay's formula to calculate the duration of the bond. Okay. Then you have one more thing which is called coupon rate. Now, coupon rate was 6%. This is the interest rate which is written on the bond, and this is what investors expect to receive. For example, if the bond has a face value of 100 and coupon rate of 6%, it means that returns are $6. Investors, they expect to get $6 every year. Now that is called coupon. But then there is another word which is called yield. Now yield is a different word. Yield of a bond. Now this is an important concept. Actually, my topic for today is yield. All these things which I explained to you before, these I consider as the background knowledge. What I need to discuss now, which is our AFM chapter, that is the concept of yield. Yield is what investors they actually get. What investors realize on their investment. Okay, this is yield. For example, what was happening? The market value of the bond, I go back here and I will actually make yields there. I will show you how to calculate the yield. Here, the bond is giving, so I would say coupon was $6 and coupon will remain $6 in these cases. Coupon will always be $6. Coupon will not change. So here what happened, the market value of bond was $100. So 6 divided by 100. I'm sorry, 6 divided by 100. So yield is 6 divided by 100, which is 6%. This is the yield here, 6%. But in this particular case, coupon again is $6, but this time investors are getting $6 over 105. Listen, very important, because what will happen if you go to the market, you will invest not $100. Market price of the bond has gone up. It is 105. So you will pay $105 and end of the year, you will only get $6. So your yield will be 6 divided by 105, which is now just 5.7%. Your yield has gone down because you are earning the same $6, but your investment value has gone up. Whatever it was $100 that was past, I am not buying it for 100. I am buying it from the market at 105. So for me, it is a $105 investment, and which is just giving me $6. In the next year, again, the yield is, the coupon is 6 and the investment value is 95. So 6 divided by 95. So what do we get? 6 divided by 95. We get 6.3%. If you pay attention now, the yield has gone up. This is the yield. So my yield was, first it was 6, then it went down to 5.7, and then it went up to 6.3. And the yield, it the changing factor was this market value. The market value of the bond was affecting my yield. So yield is what? So you get that. I go back to the definition where I wrote down, I said that yield is what investors realize on their investment. So what do I realize? $6. What is my investment? $95 or maybe $105. So whatever you realize, that is called yield. And then there is a word which is called yield to maturity. Yield to maturity, it is also called YTM. Very quick word on that. By the way, I would write down here one more sentence. I would say that yield changes from years to years. See, and you can see if I say that yield changes from year to year, you can prove that. Okay, first it was 6%, then it is 5.7%, then it is 6.32%. So yield is not a long-term measure. Yield is an annual factor, even quarterly factor. So every quarter we calculate the yields, because every quarter the bond prices are moving up or moving down as the banks are changes their interest rates or other factors. So yield changes from year to year. Yield to maturity is the total return that investors get. Annual yield to maturity is just an average. What does that mean? Listen, you said that we issued a bond for $100 at $6 premium. And we said that we will give you $6, $6 plus end of the year, this bond will be redeemed at $120, 20% premium. So it means that investors are not getting 6. In fact, they are getting 20 on the top as well. So yield to maturity is a comprehensive thing. It is a more complex thing. Yield to maturity includes everything, the capital gains or the redemption premiums, etc. So on a yield to maturity, it is not for 1 year. Yield to maturity, you calculate that what a bond will give in its entire life, not just in 1 year, but over its entire life. And then you divide it, you find out the average, and you say, okay, the average YTM is this much. So this is called yield and yield to maturity. So coupon rate and yield are different. I will speak here now. My coupon rate was 6% in this year. My coupon rate was 6% in this year, but yield was 5.7%. Then coupon rate was again 6% in that year, but the yield was 6.32. Okay, so we understand the concept of yield, maturity, duration, coupon rate, and the market price of the bond in relation to the market interest rates. I go back to our slides so that we can continue. So this is your chapter which we were discussing, bonds. And I have already given you, I'm sure that you people can see the PowerPoint slides, right? Do you guys? Okay, so this is the bond. So bond is giving interest rates and interest rate change, yield curve. We are going to discuss what is a yield curve now. So yield, we already know that yield is my real earning, and I will calculate the $6 not with $100, not. I will calculate with the market price. What is the market price of this security? Because it is possible it is giving 6, 6, 6, 6, and 6. But then what happened? Before its price was 100, then next year the price came down to 90, and then the price came down to 80, and then the price came down to 70, and then the price came down to 60 of this bond. What the hell is happening? What do you think? Why is it happening like this? Why the market price of the bond is going so down? Do you have any idea? Can you imagine something?
That's because of the market interest rate, which is increasing.
Yeah, market interest rate. Yeah, but market interest rate could not make such significant changes. I personally feel that there is a big financial problem with this company. Whoever is the issuer of the bond, whoever is the borrower, their credit rating is going down so fast that nobody is interested in buying their bonds, and therefore the market price of the bond is decreasing, right?
Yes.
So this could be one reason. Anyways, we understand and we know that yields are changing. In this year, it was 6%. Then probably it is 7%. Then it looks like it is 9%. Then it looks like, I don't know, it is 11%. So yield is increasing. So we forget about this thing. Now we go to yield curve. What is yield curve? So this is your a standard norm. This is called a normal yield curve. And you say years to maturity, 3-year bond, 5-year bond, and here these are the interest rates. So what we understand that a bond which has a 3 years maturity, it has an interest rate of 5.5%. And a bond which has a 5 years maturity, it has an interest rate probably of 5.8. So we establish another relationship that as the maturity of the bond, which means the life of the bond is increasing, the yield is also increasing. What could be the reason? Why do you think that the yield is increasing with the longer life of bond? Can anybody contribute something, please? Discussion starts.
Because the cash, the earlier the cash flow come,
No, we will not talk, no, I understand your point. We don't talk about discounting here. This is actually, yeah.
The more time it takes to repay back the investment, it should get a much better interest in terms of interest and everything.
Okay, here what we go back to our one basic concept: higher the risk,
higher the return.
Higher the return. Don't you think that investing for a long term has higher risk?
Yes.
Yes, sir.
Because if you invest in a company today, you know their financial position today, and you can predict what they can do, and you invest the money. But what will happen in 5 years, you are probably a little bit more conscious about that. So whenever longer term investments, they always have higher risk, because as you extend in the duration in the future, your forecasting starts becoming inaccurate, and risk element increases, uncertainties, they increase. So therefore, generally, those bonds which are with longer life, their yields are higher. That's very natural. I mean, if somebody says you know, one of your friend, he says you know, give me $1,000, I will return you next week, you will say no problem. But if your friend comes in and says, give me $1,000, I will return back after 3 years or after 1 year, you probably will think. So time duration is definitely, when the time increases, the risk increases. And when the risk increases, return increases. So this yield curve, it represents this thing. Now, yield curve is a very, there is a yield curve which is for a particular market. And in market, how the interest rates are, and yield curves, they reflect or represent the market. Because we are not doing quantitative finance, so I will not go into more details. I don't want to make it look like economics. I will stop it here, but just I want to tell you that sometime you have yield curves like this. These are called inverted yield curves, which mean that yield is here and duration is here. For a 1 year investment, this is the return, and for the future period, the return goes down. This happens when investors, they believe that in the short term, the market faces more risk. When there is more risk, it looks in the short term period. This is a unique situation in which the yield curve, it retains, it reverses. So this is your yield curve. Then you have higher yield curve. I have explained you. There are a number of explanations of the yield curve. At any one time, both may be influencing the shape of the yield curve. Expectation theory. We say that why this yield curve? Because, by the way, yield curve can go like this, or yield curve can go like this, a little bit flat, or a yield curve can be very much straight. So these are different shapes of the yield curve. And what do they show? They show you, number one, expectations theory. The curve reflects expectations that interest rates will rise in the future, so the government has to offer higher returns on longer term debt. If the market, because generally what is happening, that these yield curves are coming from the government securities. They are coming from the US Treasury bills. So if in the local market interest rates are expected to increase, nobody will be buying government bonds. So the government bonds will also go up. Liquidity preference theory. Liquidity preference theory, the curve reflects the compensation that investors require higher annual returns for sacrificing liquidity on long dated bonds. Listen, liquidity preference theory is a situation in which people, they prefer to keep cash. There are times of uncertainties. For example, even today, a lot of people have started thinking of, not investing anywhere. In fact, they want to keep the cash because they believe that whatever is happening, this COVID-19, then there are some global political issues, and that oil prices are going down, and it looks like that the global economy is going towards a recession. All economies are going with negative growths, and nobody knows where to invest. So people prefer to take cash. So in that case, you have businesses, they have to offer more interest rate. Like previously in 2019, probably many people were interested in investing at 8%. If somebody business is giving 8%, people would invest money. But in 2020, you cannot convince the investor to invest at 8%. Today, you have to give maybe 11% because people don't want to give away the cash. So you want to, deprive them of their cash, you have to give them more. This is called liquidity preference theory. It also impacts on the yield curve. Then credit ratings will affect. A bond's credit rating will also affect the return that is required by investors. An example of the ratings used by major rating agencies are below. AAA, AA plus, AAA minus, AA minus, and A plus. So you have got different credit ratings which are coming in. And of course, the bonds with the securities with lower credit ratings, they must offer bigger interest rates. And here, smaller interest rate, because they're higher the risk, higher the return. Remember the same theory? So these are high default risk. Risk goes up, returns go up. So credit ratings are up there. And by the way, there are always questions in exam. We have to calculate cost of capital, the cost of debt, the bonds. Why I'm speaking on this thing? Because when you will do your investment appraisal, and of course, you are doing advanced investment appraisal. An investment appraisal, we use WACC. And in some questions, they give you the WACC. In some questions, they require you to calculate the WACC. And how to calculate the WACC? The company will have capital. Within capital, they have bonds. And then you have to calculate the cost of the debt, which is the bond. I mean, the cost of that bond. And for that purpose, we will be using our credit ratings, yields, and etc. All these things will be used. So nothing is irrelevant. Everything is relevant. Yield spread, we say. A very simple word you should remember. What is yield spread? You have two types of bonds. And one bond is giving a yield of 5%. Another bond is giving a yield of 6%. So there is 1% difference. And that 1% difference is called yield spread. That's all. Now, you may like to read it 2 long pages from the book. That is another case. But yield spread, in a very simple term, it is the difference between the yields given by two different securities. It is always a comparative measure. You always compare it. And this yield spread will actually, it depend on how much yield spread. It is the extra return, because company A is giving 5%, and in company B, people probably are expecting 6%. Why company B is offering 6? Because they know that at 5%, nobody will buy their bond. That's why they are giving 6. They are giving 6 because they know that people, they expect more. And why it is more? Because of their credit rating. Maybe this has a credit rating of AAA and this has a credit rating of AA. So this is the factor. And also maturity, because 5% is for 3 years. And this is what the bond they are offering is probably 4 years bond. So because the maturity is longer, and when higher the risk, higher the return, higher the maturity, higher the risk. So maturity, it also depends. So we understand that what is yield spread and why it happens. Two things. So rating, for example, this is a company which has AAA and 3 years, and we say 18 points. What does that mean, 18 points actually? 18 points is, you always compare it with the risk-free rate. You say the risk-free rate is 4%. Okay. If the risk-free rate is 4%, this bond, it will be actually giving 4.18%, 18 points. So actually 1 point is 0.01%. And if this company will issue the bond, they should be doing it at 4.75%. We call it 18 basis points, 75 basis point. Sometimes it is 150 basis point. We say that the company estimates that their bonds will be issued at 150 basis point. 150 basis point. And the risk-free rate is 4%. So it means that they should be offering at 5.5%. Because probably this company has a rating B. So as the rating is going down, these basis points are increasing, and this is now becoming the spread, yield spread between this one and this one. So basis points, you call it 75 basis points, 18 basis point, 1 basis point is 0.01%. So 75 means 0.75%. Okay, we will use this information as well in doing question. By the way, next lesson is for doing questions. In next lesson, I'm not going to teach, we are going to do some questions together. Then we have weighted average cost of capital, WACC. I already have covered that thing. And this formula we discussed in our previous session. I already have uploaded the video. Market, and please pay attention, value of equity, VE. It is market value of equity. This is market value of debt, of debt. Market value of debt. So you always talk about market value because the face value of the bond was 100, but in the market it was sold for 95. So you should be talking about 95 because this is the value as of today. This value maybe was in past, it is irrelevant. We don't care. We talk about how much it is today. So this formula we actually made on our Excel file together, and we did one question also with this. Then you have calculating market values of debt and equity. Again, I discussed this topic also in the previous session. You may need to calculate these market values if they are not provided in a question. Chapter 8 deals with the valuation of equity. So like I said before, that chapter 1 and chapter 2 are basically very introductory chapters for the future chapters. So we will be discussing a lot on market value of equity with using CAPM and betas in later chapters. The value, to value debt, you need to calculate the present value of its future cash flows discounted at a required rate of return. Okay, listen, a very general concept which you will use in many places. Okay, this is one technique you should remember. I say that price of bond, how much the price of the bond should be. You know, it will be equal to present value of future cash flows. Listen, an investor will never give more than what he will receive. Nobody will give more than what they receive. Let's suppose that you have a bond and that bond is expected to give $6 here, $6 here, $6 here, $6 here, $6 here, plus 100 back. So the bond is giving actually 130. If you see, it is giving 130. 6 times 5 plus 100. But it does not give 130 today. So this is today times 0. You have to discount all these cash flows. And when you discount all these cash flows with your discount rate, with your WACC, it comes out to be 98. Now, maybe the bond, on the face of the bond, it says 100. Nobody would give it 100. The market price would be 98. Why would I give it more than what I need? I know that what I'm going to get, the sum total of all the future cash flows are just equal to 98. I can't pay 100. So this is valuation. To value debt, you need to calculate the present value of its future cash flows discounted at the required return, pre-tax. And by the way, not post-tax, pre-tax. Activity 4, there is Mantra company bonds have a nominal value of $100 and a total nominal value of 0.049 billion. The bonds pay a coupon rate of 6.2% annually. Further information on credit spreads and yield curve spot rates are given below. So AAA 1 year, this is 8, maturity is there, 1 year, 12, 2 years and 3 years. So you have been given credit spreads and yield curve spot rates are given below. So these are your AAA bonds ratings. These are basis points, 8 basis points, 12 basis points, 18 basis points. Yield curve spot rate is 4.55 and 5.5. These are your interest rates. If you see that for a longer period, interest rate is higher. And their required rate of return is 4.58. See, AAA rating, basis point is less for 1 year. But the same AAA company will have a more basis point after 12 years, for 2 years, because for 2 years it is giving 12 basis point because risk increases. And when the duration is 3 years, a further higher rate of return is given. And then yield spot rates, interest rates, how much the yield is coming, 4.5, 5 and 5.5. It says complete the following calculation to estimate the market value of Mantra company's debt. This is what we need to do. So how much is your coupon rate? Coupon rate is 6.2. And you have a £100 bond, a total nominal value of 0.49 billion. So what they show us on the next slide, this is where we have to fill in. This is actually the table, and then this is the data. Wait a minute. Yeah. Okay, complete the following calculations. Actually, I think that I missed some part of this question. Following calculations to calculate the total market value. Okay, I'll skip this thing. We'll do it from the book together. I'll move forward. There is one question. In any case, I told you that I will do the questions in the next session. Okay, calculating the WACC. WACC was simple. It says that Mantra has a total market value of 1 billion, split 50% debt, 50% equity. Mantra has a cost of equity of 8% and a post-tax cost of debt is 3.9%. Tax is 30%. So how do we calculate here the WACC? Can you people do this thing, WACC calculation? Should I do it for you? We said that value of equity divided by total capital multiplied by the debt. So you suppose that you have capital $100, because they don't tell us how much it is. They just said 50% equity, 50% debt. So if I say that my total capital is 100, then my equity is 50 and my debt is also 50. So how do we do that? 50, which is your equity, and market value, they did not tell us. They said that this is the market value of 1 billion. So 50 divided by, you will say 100, multiplied by 8%, multiplied by 8% plus 50 divided by 100. This is debt, multiplied by the cost of debt. And how much is the cost of debt? Cost of debt is 3.98%. Should I multiply it with 1 minus t? Remember that tax thing?
Yes.
Should I do that?
Yes.
It's post-tax.
So what they are giving us, This 3.98 is pre-tax or post-tax?
It's post-tax.
Post-tax.
So if it is
So we
post-tax,
don't,
which means after tax. So then should I do 1 minus t?
no.
No, I should not do it. If they tell me that it is pre-tax, then I multiply with 1 minus t. This is already post-tax. Why should I do that? So we should not be doing this one. We should not subtracting it. So you will find out, I mean, so this is actually, I think, 50 by 100.
5.99%
This
is
is 4% plus this is 1.99, huh?
5.99%.
Yeah, and it should be 5.99%. That's all. I mean, it's very simple. It's rather childish, I would call it. Assumptions made when using WACC for project evaluation. Okay. Now here, listen. Now I'm going to go back to our discussion mode. Like I told you that we have 3-4 components of preparation. One is lecture, one is discussion, and probably you would be speaking a lot also. Okay, listen. You have 2 things, and this is what I'm going to speak now. It is going to help us in chapter number 3 as well. So I'm building up your foundation for chapter number 3. So you have company back, okay, which is probably 9%. So this is your company and your business, and you have got within your company, you have a capital structure of 30-70, which means 30% debt, 70% equity, debt equity. Then you are actually investing in a new project. And what you need a project back. The company back I cannot apply here, because a project might be different than the existing situation or scenario of your company. Your company has got 9%. So what we were doing before in F9, that they told us that a business has a discount rate or cost of capital or a WACC 9%. This is the project. And many times we discounted the cash flows with the same thing. And by the way, what we did in F9 also, that we had 5 years cash flows and we discounted all the 5 years with 9%. We discounted all the 5 years in 9%. All of you people have done this F9 thing. You know that you've got cash flow in year 1, year 2, year 3, year 4, year 5. And then you said discount factor at 9%, 9%, 9%. It is not going to happen now. We might have to see that in year 1, my WACC is 9%, but in year 2, my WACC might change. In year 3, it might change. Why? Because my yield will change on the bond. My cost of equity will change because of the capital structure. So you cannot assume that your WACC will remain 9% for the rest of the life. So number 1, this assumption is gone. Number 2, the company has a capital structure of 30-70. The project has a capital structure of probably 100% equity. So there is no debt in the project. You are doing the project with your own money. So capital structure changed, finance risks change, and your WACC should change. And then the project has a different nature. Your company is a manufacturing business. You are a dairy farm. You produce the dairy products, milk and butter and cheese. And now you have decided to open up a retail store, a grocery store. So a retail chain and a dairy business are 2 different things. Business risk is different. So again, you cannot take 9%. So when you talk about using the WACC in any particular project, if you want to use this WACC for a new project, your assumptions are that this new project, if you want to use this 9%, if you want to use this 9% on a new project, you assume that the new project has the same capital structure as the company, or maybe capital structure is different. It is possible that it has a capital structure different, but project is so small. Company is $500 million and project is just $10 million. So it is so small that in that case, you can ignore the differences. And you can say, I will use the same WACC. Maybe the project is a different nature. It is a retail store. Maybe it is 100% equity, capital structure is different, but I'm using the same WACC because the project is too small as compared to the company. But if the company is 500 and they are investing in a new project of 100 million, now it is not insignificant. Now it is a material amount. So in that case, you can only use this 9% if the capital structure remains same and if the nature of business remains same. If the nature of business changes or if the capital structure changes, you need to find a project WACC. You call it a project WACC. That particular WACC which you use only for that particular project. The WACC can only be used for project evaluation if in the long term the company will maintain its existing capital structure, which means that financial risks are not changed. Like this new project will not change the equity capital thing, equity debt thing. And the project has the same risk as the company, like the business risk is unchanged. Like I said that, you know, a manufacturing business investing in a manufacturing business. If these factors are not in place, that is the risk changes, then the company's existing cost of equity will change. Of course, risk will change, cost of equity will change, and therefore you have to calculate project specific cost of capital. We call it project WACC. And this we are going to cover in chapter number 7. I am repeating it again, chapter 1 and 2 are just opening you doors and windows for the next chapters. And this is going to be discussed in chapter number 7, advanced investment appraisal. Assessing corporate performance, ratios you have to do. Now, these ratios are coming back exactly the same what you did in F7. There is nothing new. Same performance ratios, market ratios. You know, you will start with ROCE, you will do dividend yield ratio, dividend cover ratio, you will do EPS. The only thing is that ratios are same, but application and interpretation is more detailed. Interpretation analysis is in more detail. So ratios are normally split into 4 categories. I'm sure you people remember we did it in F3. Honestly, we started doing it in ACCA F3. Then we did them in F7. Then we did them in F9. And now we are talking about T4, AFM. Same, profitability, debt, liquidity, shareholders, and investor ratios. So key ratios are the same, which we did before. We said that first is ROCE, return on capital employed. And I'm sure that my friends, they know what is capital employed. What is capital employed? Can somebody tell me? I just forgot it. Yes, who will speak capital employed? Where is, let me see who I'm going to ask. Nefas?
Yes, sir.
What is capital employed?
The total capital allocated by the company, assets minus liabilities.
All liabilities?
No, long-term liabilities only.
You minus long-term liabilities?
No, sorry, minus liabilities excluding long-term liabilities.
What happened? You got confused?
Minus total liability.
Minus current liabilities.
So could it be said also like it's equity plus non-current liabilities?
Yeah, I'm writing down.
Yeah.
Different ways, because sometimes they give you data like this. It is also called as, it will depend on the data which has been given to you in the question. Okay, this is enough. I can write down one more, but then it will confuse you. Total assets minus current liabilities, or equity plus non-current liabilities, or equity plus interest-bearing debt. Interest-bearing debt, these are non-current liabilities. Because on short-term liability, you don't pay debt interest. So this is your capital employed. And so ROCE, return on capital employed, PBIT, profit before interest and taxes, divided by, so either you do it like this or you do it like this. They will give you the same thing, because here revenue will be cancelled out with each other and these two will remain. Or you can say this is actually profit margin, this is asset turnover. So either you calculate like this, or you calculate in this way, or you calculate in this way. So you've got three ways, because it will depend on the scenario, what type of information they have given you. Probably they don't tell you capital employed, they say asset turnover ratio is this much. So if they tell you asset turnover ratio is this much, you just multiply it with profit margin, you get the same thing. This is just like juggling with the same formula, because in exam question, it's not that they give you what you want, you have to figure out with the data they have given you. So they might not give me my capital employed directly, they give me asset turnover, and then I just simply multiply with my profit margin and I come to ROCE. Then you've got shareholder investor ratios, total shareholder return. We know that total shareholder return was our first lecture, first 20 minutes. So shareholders, what do they get? When you invest in a business, when you buy shares, what you get is the dividend every year plus the capital gain in the share. I'll speak it again. Listen, how do I see this thing? And by the way, this is also called, interesting thing, shareholder return. I can give you another terminology. It is also called sometimes, not in your book, but sometimes it is called yield on equity shares. Yield on equity shares. So in your books, generally we are using shareholder return word, but the second word you should also remember. So let's suppose that, 01/01/2010 share price was $20, okay? Share price was $20. Then what happens that on 31st December 2010, dividend $3 was given. Then on 31st/12/2010, the share price was $22. And let me call it like this, 2512. 2512. Dividend $3. I changed the date. Why did I change the date? I will explain you. Very important thing. Now, what the investors are getting, any investor, if you purchase this thing on 1st of January, if you invested $20, what did you get from them then? You get a dividend of $3, right? What you got is $3 in dividend. You got $3 in dividend, plus you got $2 in capital gain because shares also increased. So you essentially made $5. You actually, by making this investment, you got $5, and you made $5 over an investment of $20 because you invested 20. So don't take the market price here. Do not take the market price here. Take the beginning price 20. So it means that 5 divided by 20. And 520 by is 1/4, it is 25%. It means that this share is giving a 25% return, or it is yield is 25%. Now, why did I use this date, 25 December, I said? I'm sure that you know that we say that share price could be cum dividend and it could be ex dividend. What is cum dividend, share price, and ex dividend? Can somebody speak?
Cum dividend means including dividend.
Exactly.
And ex dividend means excluding the dividend.
Yeah,
So
ex dividend means after dividend. So
after
remember
dividend.
how much dividend they, what is the ex dividend price here? 22. I can assume that on 25th December, approximately, you know how much the price of the share was? Approximately.
23.
Can I say it? Can I assume it? It can be assumed. It is not accurate, but it can be assumed. Because what happened? That as the time of dividend is coming close, we know that this is the time where dividend will be given. So the share price starts increasing gradually because it is adding up dividend. And when here the dividend of $3 was given, the share price will fall down again. So this is called X dividend and this is called cum dividend. So here it is 22. The dividend was given $3. So it is possible that before giving away the dividend, the cum dividend was 25. And then we strip away the dividend. We say, okay, you take $3, you take $3. So $3 are gone. So everybody knew now that within the share, there is nothing inside. It is just pure the value of share, and that is 22. So you will always take, by the way, in this calculation, which I just did, take the share price at the start of the year. So this is shareholder return, what we calculate. Then some ratios on investors, return on equity, we take earnings divided by shareholders' funds. What do we mean by earnings? Is it PBIT?
Profit after tax.
No, now listen, we've got different things. One word we say PBIT, which means that profit before interest and taxes, right?
Yes.
Is this amount available to be given to the shareholders? Can we give this, if my PBIT is 1,000, can I give 1,000 to the shareholders?
No.
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 We still have to pay interest, we still have to pay taxes. So when we use the word earnings, it means that after everything, after paying out everything, which means that available for distribution. We call it available for distribution. So when we use word earnings, so don't get confused that what type of thing is it? Is it PBIT, net profit, what? So earnings, when we say it, means something pure. Everything we have given out. We have given out interest, we have given out taxes, we have given away the preference dividends as well. And this is for distribution to equity shareholders. I'm putting it in bold because preference shareholders, I have already settled with them. This is only for the equity shareholders. And we say, so this is the earning and this is the shareholder fund, because this is what shareholders have invested and this is what is available to them, 10%. This is what they can take home. Then earnings per share, EPS. Again, earnings divided by number of shares. We did EPS in F7, we did EPS in F9. If anybody is not clear, they should go back and watch. Then you have price earning ratios. By the way, I will be using these things in calculations because these things we will calculate a lot, because we have one topic which is called business valuation. And in business valuation, these ratios will be used a lot. And we will be using EPS. So do not be scared. I'm going to manipulate with them a lot. And while doing questions, if anything extra is needed, we will discuss that again. I don't want to discuss now because as theory, we have discussed it in previous exams. Here, I don't want to discuss in theory, but when I do the questions at that time, I will use it. And then you have PE ratio. Just somebody tells me what is PE ratio, what it tells you. PE ratio. You can see the formula, market price of the share. Let's suppose a share has a market price of $20 and the share has an EPS, earning per share is $2. So your PE ratio comes out to be 10. What does this 10 tell you? Is it 10 kilogram, 10 centimeters, 10 millimeters? What is it? What do we understand by this number 10?
By what factors the investors are willing to invest over the earnings?
Yeah, I mean, it is the factor. It is the number of times the investors are willing to pay as compared to their earnings. Or to put it in easy words, you can say that if your P ratio is 10, it means that this particular share, if you invest, you will recover back your money in 10 years. Forget about the present value and the discounting, because you will get, today you will make $10 investment and then $2 earnings will happen. And it will take 10 years before you get back your $10. This is like in how many years the investment is going to be recovered. So if one company has a P ratio of 10 and another company has a P ratio of 13, which means that if you invest in this company, you are getting back in 10 years. And if you invest in this company, you are getting back in 13 long years. Which share is preferable? What message it gives us? Two different PE ratios. One is bigger, one is smaller. What message it gives us? Share number B is taking 13 years.
It has higher risk.
It has higher risk. Actually, it looks like, actually, if you ask me, this is the preferred share in the market. Because the market is willing to pay 13 times more, because it looks like that market has big hopes with this share. Investors, that's why investors are willing to give so much, because they believe that earnings from the next year will start increasing, and therefore they are investing. Whenever you see a higher PE ratio, it looks like that, investors, I mean, this is getting $2 and it has a market price of 20, EPS of 2, either EPS is also 2, but market price is 26. So here, in order to earn $2, you invest 20. Here, in order to earn $2, you invest 26. So why market or why investors are willing to invest more? It shows the trust, because people are trusting this company. If there is another company C, which has a market share price of, which has EPS of 2 and market price of the share is 12, and their price earning ratio comes to be 6 here. It looks like that people are not trusting this company and they are not willing to pay more for the share. In order to earn $2, they are saying we can maximum give you 6. They are not trusting it a lot. I mean, they can maximum giving you 12. So actually a higher PE ratio is a sign of, an improved trust by the market. Clear? Okay. Then we move forward. What else was there? Risk management, a very, 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 very important sub area from your subject. Business risk and financial risk. Business risk is due to the nature of business. Due to the nature of business. For example, a factory has a different business risk. Probably a shopping mall has a different business risk, because it's a rented property. There are 100 offices, all of them are unrented. On the 1st of every month, everybody comes in, gives you the rent. Everything is planned, no problem. Apartment buildings, shopping malls, business centers, they are very, 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 very safe investments, because they don't have sales volume going up, going down, fixed variable costs going up, going down, production losses, wastages, sales demand, market demand, nothing like this. All offices are on rent, and rent is agreed for the next 1 year. You can exactly calculate your annual income, multiply your rent with 12, and you find out everything. It has a different business. This is what? You make chocolates. Now, sometimes the demand go up, sometimes the demand go down, sometimes raw material becomes expensive, sometimes raw material becomes cheap, sometimes sales are more, sometimes sales are less. So many factors. Where do you see risk is more, risk is less? Of course, risk is more here. Here the risk is very little. This is called business risk. So business risk is which you are facing as a result of the nature of business. And then you have financial risk. Financial risk is because of the capital structure, like how much equity, how much debt. One company has, so this is equity, this is debt, Entity A has 80% equity, 20% debt. Entity B, it has 60% equity and 40% debt. Naturally speaking, their risk is more, because more interest mean more interest payments, fixed costs are more, risks are there. Here, risks are less. So they might be in the same business. These both are the same businesses. So their business risk is same, but their financial risk is different. So the total risk which we talk about, the risk comes out from two sources, business and financial. And we will discuss them both. Business risk, I explained you what is business risk. We say that a business risk arises from the type of business. And a business risk is a mixture of systematic and unsystematic risk. The systematic risk comes from such factors. Systematic risk is the risk because of the total economy. The systematic risk is the risk of, listen, these are different companies. One supermarket, one business center, one factory. They have their own different business risks. But then we say systematic risk. They all are working in the same economy. So this is one risk. One risk which is applied to the entire environment. This is called systematic risk. And then there is a risk which is in these individual businesses. This is called unsystematic risk. Unsystematic risk is business specific. Systematic risk is the environmental risk. I mean, if you talk about, let's suppose that you say that, country A in Asia, I'm not writing a lot of details. When we say Asia, we understand many things. Country B in Europe. Generally, we assume, now I don't want to give here names of any countries, but generally we assume that in Asian market, it is underdeveloped, markets are not clear, risks are generally high. There are, some unwritten business rules, unwritten business laws. Sometimes there are corruption, there's the issue of corruption, and people have lower income level, buying powers are less, etc. These are the issues here. In Europe, generally we believe that business environment is transparent, economies are stable, governments are democratic and are very stable, and we believe that the risks are generally less here. So you have two businesses, they both are the same businesses. You do the same thing, but you open this entity in this country and this entity in this country. So their unsystematic risk might be the same because they both are in the same business. So their business risk might be the same, but their systematic risk is different because this is a different country and then this is a different country. Their business, political, economic environment is different. Here, the political, economic, legal, business environment is different. So you should remember that systematic risk, it comes from the system. System means the overall environment, the overall economy, and unsystematic risk is due to the nature of business. And we will discuss again it in next chapter. Every time I say next chapter, actually this is how the book is written. Chapter number 2, we are just making introduction to many things. Non-business or financial risk. Financial risk is the volatility of earnings due to the financial policies of a business. Financial policies of a business, which means structure of finance, how much equity, how much debt. Okay, now that's very interesting. Please pay attention. It says that business risk goes up, financial risk goes down. It is actually not like this that they depend on each other. It is not that they depend on each other. It is how the investors they see. You know what? If you know that a business is risky, there is a business which is risky. Let's suppose an IT startup. Okay. I know that IT startup by nature, it is a very risky business. So I would prefer to do this business in a low risk environment. I'll go to some very advanced country in a low risk environment, because I know that already this business is already very risky. So at least I should not face both risks. If this is so risky and then I go and open it in a high risk economy, I will be devastated. So if my business risk is higher, I will try that if my financial risk is higher, I will try my business risk should be less. So you try to make a balance between these two risks. You would never like, that both risks are moving up. You don't want both of them to move up, because then you are in a very high risk zone. So this is what it says. A business with high risk, high business risk may be restricted in the amount of financial risk it can sustain. Because if financial risk is also high, this may push total risk above the level that is acceptable to shareholders. So you would never assume, or you would never try to have both of them going up. This is, very logical, rational. Any sane investor would try to balance out these two things. So this is end of this chapter for today. And next time what I'm planning, I want to do a few questions. And then if we will have some time, we will start chapter number 3 as well.